Good afternoon, ladies and gentlemen. This is Robert Rayburn here at Life Pro Asset Management. It is April 28th, 2021, and it is hard to believe that it is already the end of April. And I'm glad to say that so far, there's still a couple days left in the month, so things can obviously change. We never want to jinx it, but obviously a far more constructive month performance-wise than March was. But more importantly, a lot of the things that we thought would come to fruition have on this rebound. But now it's the time to look forward. As we rebound, we want to understand what that next stage of the recovery in the US economy looks like. And as we're going to discuss today, it is increasingly looking like we're going to have a big economic boom in the second half of 2021. So what's our focus as portfolio managers is to prepare the portfolio today for a prolonged economic boom. What does that mean and what does it not mean? It means that we want to target areas of secular growth or emerging areas of secular growth that are going to directly benefit from this new economic boom that is taking place. Part of it will be temporary. We'll get sort of a sugar rush from increased fiscal spending, monetary policy, but part of it's going to last a little bit longer than a lot of economists and strategists out there are assuming. So we want to be prepared for that. Not everything has to be bad news, as has been the case over the last 2 years. So let's prepare the portfolio for, believe it or not, I know this is hard to believe, regardless of which side of the aisle we're on, for some good news. So what I'm going to do is I'm going to go ahead and share my screen here. And that's the title of this week's presentation. Here comes the boom. There's a reason for this. There's a reason for our thought process around this. 65%. This is the critical vaccination mark that we've seen in countries such as Israel and in the UK, where we had an initial decline in cases, plateau, and even some cases a rise. But then as those countries reached 65%, in particular Israel, we saw a mass acceleration downward in the number of new cases after that vaccination mark had been reached. The US is approaching, and in some cases has reached 65% across the US. And we've actually started to see the tangible data come through where cases are now precipitously, in many cases, falling across the board. Now, we can debate whether it's a vaccine related cause or, in some cases, maybe the virus has gone away. But at the end of the day, we just pay attention to data. We pay attention to the numbers. We try to draw correlations between those data points and then invest based on that. So what does that really mean at the end of the day for us as investors? With COVID on the retreat across America, it is allowing those reopenings not just to take hold, but to expand and accelerate across the country. Reopenings plus cheap money plus more jobs equals an economic boom, in our opinion, based on our research. Lastly, is this the beginning of the great carbon energy-based boom? This is going to sound crazy with everyone talking about renewable energy, but there is many facts on the ground right now that are leading us to believe that the most hated trade out there, energy, could be in the first to second innings, first inning really, of a secular bull market. So we're going to talk about that. I'm sure you've noticed some trades going through the portfolio that have reflected this view. So we want to discuss that. Now, in terms of performance, we're making ground here. Obviously, last week we were down around 4% year to date. This week, we're almost back to flat, which is good to see. And we're continuing to reposition the portfolio. We're continuing to put trades in place that we think will reflect that second half economic boom here in the US. And we want to continue to make up ground But the good news, of course, is that when we look over those one-year numbers continuing around that 100% level, one of the top performing strategies across the entire United States. We're proud of it. But again, we want to make sure that that performance is not just backward looking, but that we're in a position with the portfolio to continue growing client accounts in a high performing way in the future. And the one way we do that is we want to position for those areas of long-term secular growth. You'll notice while we have made some trades that the core part of that portfolio remains steady Eddie in those core areas of secular growth, the digitization of everything across the world, the digitization of the global economy. Since inception, up 224% versus 86.85 for the S&P 500. So overall, whether it's over 1 year period or since inception, we've been able to generate ample outperformance versus a low cost index product. In over 1 year, 51.32%. Since inception, 137.29% of outperformance after fees versus the S&P 500. Now, this is what we were talking about, ladies and gentlemen, where we see hospitalization rates after a tick higher starting to accelerate downward again. And then daily mortality never ticked up. Why? Because the 65 and over crowd has already reached that 65% vaccination mark that we've been keeping our eye on. Now, the rest of the country is catching up. We actually see daily vaccinations starting to drop in the US. Why? Because there's just fewer and fewer Americans who haven't been vaccinated. So the volume of new cases, the volume of new vaccinations on a daily basis is going to start to come down just because we're running out of Americans to vaccinate. So very key stat here, 65% was the magic number in Israel. After the initial leg down in cases, Israel had a slight tick upward. And then once it reached 65%, we saw a big drop down to the point where Israel is now completely reopened without masks. So this is something we want to pay attention to. Here are the rolling 7-day cases in the United States. Again, we see here in early March, this drop, then we saw a tick higher. And now as we approach 65%, we're seeing another big leg lower. We want to prepare for that. Here we see it being reflected in the actual data. Durable goods seeing a huge surge upward over the last month. And what we're now seeing is when we look at the survey across the United States, are jobs plentiful or are they hard to get? And we see here is a big tick upward in terms of people saying jobs are plentiful. So remember, easy money, reopenings, and of course, a booming labor market gives Americans a lot of money to spend, and we're a consumer-based economy. 73% of our growth comes from the US consumer. This is the most important chart for me, and I believe that most investors should view this as the most important chart for them as well. When I'm looking at whether or not an economic boom or an economic expansion is sustainable, we want to look at what we call the inventory cycle. What does that mean? We want to look at the level of inventories across the board versus demand. When we see a huge backlog of new orders come through the system while inventories are low, that's very, very bullish. Why? Because all those suppliers have to expand their inventories, and guess what they have to do? They have to rebuild, and that leads to more new orders upstream. That feeds the whole economic growth cycle. Where we get bearish is where inventories are really high and new orders start to taper off. So in other words, companies have to start destocking their inventory. With inventory so low and demand so high, guess what? That means over the next few quarters, not only are we getting new orders on the front end from consumers, but companies themselves have to rebuild those inventories to actually meet that demand from consumers. So this is a very, very bullish chart. Second, the symptoms of the market are telling us that we're entering a boom. You know, we talked about this time and time again. Pay attention to the symptoms. Don't try to identify the causes. pay attention to what the market is telling us. Copper is breaking out, which is a function of economic growth, an economically sensitive asset, while gold is continuing to maybe not sell off, but not participate in the rally. In other words, copper is outperforming gold. Economic growth is outperforming protection and fear. That's important. That's a symptom that we want to pay attention to. Please remove your initial thoughts on gold and copper and everything else. Just pay attention to the price movement and what does that tell you about the broad-based US economy. Second, we want to make sure that we're avoiding the areas of the market that were at the center of the previous storm. We've talked about this a few times, but just a reminder, whether it was the banks in 2008 or whether it was technology in 2000, we had that initial rally. And then those stocks started to taper off and underperform. For the next 6 to 8 years, they were basically dead money. Airlines are similar. We have not rushed into airlines or cruise liners or anything like that. They've only survived through the mass issuance of debt. So over the next few years, these airlines and cruise liners and other areas that were at the center of the storm are going to have to spend all their money and their profits on rebuilding their balance sheets. And obviously, if we're bullish on oil and we're right, that's not great for airlines. That's their chief input cost. So just something to be aware of is stocks at the center of the previous market storm tend to suffer from prolonged hangovers. So we want to avoid sort of the low stock price symptom where we go in and just buy stocks because they have a low stock price. Buy good companies that are good getting better. Now, let's talk about energy, ladies and gentlemen. Everyone hates energy, right? We have a Democratic administration that is very pro alternative energy, anti-carbon based energy. On the surface, that would seem obvious to sell carbon-based energy, buy solar stocks. But remember, stocks move as a function of profitability and revenue growth. So let's look at what could be driving everything. Obviously, for oil stocks, oil is important. So what do we see here? Over the last few weeks, the XLE has pulled back about 19% and oil service stocks about 33% after an initial rally. Remember, we wanted to be careful. We never like to play the very first initial move off a bottom in stocks. We like to wait to see how things play out. We want to see whether or not they make those higher lows. I'm fine investing in the second inning versus try to get the first inning and get burned. So what we see here is this decline, but guess what oil did? Oil is actually up 2%. When we see this type of dislocation, typically the stocks at some point catch up to the commodity. Now, why did the stocks sell off? This whole fear over India and impending shutdown as it relates to the COVID breakout there. But now what we're seeing in India is those cases are starting to roll over. The other thing that I think is very, very important is that India is not what moves the oil needle. America and China are the largest consumers and net consumers of oil and gasoline and distillate products and petroleum products. All that's very, very important when we're thinking of energy. Second, notice this, energy relative to the S&P 500 is near all-time lows. I think it's very, very important. Every single time we've been at these levels in the past, they have been an inflection point for a multi-year bull market in energy. Every single time, whether it was the 30s, whether it was the 60s, 70s, whether it was in 2000, everyone was bearish and everyone had a reason why oil would never come back. At some point, it comes back. And how can it possibly come back with this bearish backdrop that we see in place? Well, guess what? Believe it or not, ladies and gentlemen, the level of demand for petroleum products is now approaching 2019 levels, even though the level of economic growth hasn't quite reached those levels yet. So in other words, oil demand is back to 2019. We're still seeing a huge ramp up in economic growth. So at some point, we're going to have a shortage in oil, even though there's a lot of oil out there. Now, this comes down to the billion-dollar question. There's a lot of oil out there. How can prices be bullish? Well, a few things. The energy industry, now I'm from Canada originally, so the Canadian stock market, the Canadian investment community is very centered around resources. So we have a big background of following these cycles. The one thing that the energy industry has always been guilty of has been irresponsible discipline as it centers around drilling. When they get bullish, they all say they're going to have discipline when it comes to drilling. And guess what? Prices go up, and every single person and company out there gets a hold of energy equipment and drilling equipment and starts to drill, 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 right? That was the mantra of the last decade: drill, baby, drill. This time, though, we have a Democratic administration. What are they doing? They're cracking down on drilling. So guess what? Energy consumption's going up. We have an administration that hates carbon-based energy and is cracking down on drilling. That's creating a supply-demand gap, not just today, but in the future, because petroleum consumption is going up, believe it or not. I know, despite what we were in the press, it's going up, and the level of production will not be able to keep up because the administration, both at the state and federal level, are cracking down on drilling activity. So what this means is we need to focus on energy service companies and production companies that already have those production capacity in place. In other words, they can realize the benefit of a rising oil price through oil production, and of course, from those established companies spending more on their drilling pads. So this is the backdrop for why we are so bullish on energy right now, why we've steered the portfolio that way here over the last week or so. Real quick here on earnings. Earnings are surging. Earnings are going parabolic. Earnings are the mother's milk of the stock market, of stock prices, of stocks. And so we want to pay attention. This is the foundation of healthy bull markets. If we see a bull market rising up and to the right and earnings are flat or falling, that's not a good sign. When we have earnings going up, remember, year one is multiple expansion of a recovery, the anticipation of the recovery. Year two, we need to see follow through from earnings. We've talked about this month in, month out, week in, week out. We need to see the recovery in earnings in year two of the recovery, ladies and gentlemen. And guess what? We're not only seeing a recovery in earnings, we're seeing an earnings boom. This is good. This is bullish. And then, of course, another positive symptom from the market, semiconductors continue to rally. There's a huge semiconductor shortage as well. And semiconductors go into everything, every type of widget that we own and operate and use. And so when semiconductors go up, that tends to mean that overall volume of products across the global economy is rising upward and to the right. And then, of course, we talked about this last week, UPS and FedEx, they continue to break out. They are sort of the backbone of the consumer supply chain. When those are going upward and to the right, that's good. Guess what? Amazon, good earnings. So again, let's put all the pieces of the puzzle together in terms of what this all means for the economy and for the stock market and how we should position the portfolio. And then lastly, but certainly not least, the credit markets remain healthy. Until this really starts to deteriorate, it's hard to get long-term bearish. So again, implied credit risk across the credit markets, across the banking sector remains extremely healthy. This gives us the green light to remain on offense across the portfolios. So overall, ladies and gentlemen, as the probability of a prolonged economic boom increases and is on the march higher, we want to prepare the portfolio for offense. There's a time and a place for defense and offense. Now is the time for offense. We are approaching that 65% mark in vaccinations. Critical mark. That's where we see the next leg lower in overall COVID cases. The pieces are in place then for a potential carbon-based energy boom as the regulation of the new administration cracks down on new drilling at the same point where we see rising consumption of oil and petroleum-based products. Just go to the gas station, ladies and gentlemen. Look at those gas prices. I just had to fill my tank up yesterday. It was kind of painful, but the good news is that's also a function of a healthy economy. And of course, all those market symptoms we talked about today, whether it's gold versus copper, or copper versus gold, mind you, or whether it's UPS and Amazon and the stock prices and the stock charts there, or we look at semiconductors, whether it's on the fundamental basis or on the price chart basis, all of that points to one picture, and that is a potential for a large economic boom in the second half of this year. So once again, ladies and gentlemen, thank you so much for all of your support since we've started as a firm, and obviously through the ups and downs of COVID and then the recovery. We are so gracious for all of your business. And if you have any questions or concerns, please feel free to reach out to your advisor, or you can reach our central offices here at 888-543-3776. Thank you again, and have an absolutely fantastic weekend, and we'll talk to you again next week.